Okay, I've got the top of the hour. Let's jump on in. Others can join, as they get here. But want to be respectful of your time. Welcome to the Financial Plan Workshop webinar on behalf of the Birchcreek team. I thank you for attending today. We have a ton to pack into an hour. So just note, we're not going to go into a ton of detail in depth on many of the topics that we'll go over. The goal of today is to give you a sense of the various areas a comprehensive financial plan would be comprised of, and overall of some of the impactful planning strategies you can use. And this should be applicable, and hopefully you have at least one or two takeaways, whether you're a DIY investor, kind of running things on your own and doing just a check-in, or someone who has engaged a financial advisor and has chosen to delegate a lot of these uh, topics. So just note, any comprehensive financial plan is going to include tax and legal elements. It's important to note that we don't provide tax or legal advice. You should consult your CPA or attorney before implementing any of those related strategies. This is general information for education purposes. Of course, we can only give specific advice to existing Birchcreek clients that have engaged in an advisory agreement. So again, welcome. Lots to get in today. We'll go over the foundation of a comprehensive financial plan, more specifically defining your goals, risk tolerance, formulating a personal balance sheet, your assets and liabilities, as well as cash flow, so income and expenses. Related to cash flow would be, how does that relate to most people's largest goal, which would be retirement planning, the largest bucket they save over their lifetime because it's oftentimes the most expensive goal. We'll get into some portfolio elements, your investments, stocks, bonds, cash, and so forth, and tax optimization. So some tax strategies, especially around retirement and specifically earlier years of retirement. Risk management, not only on the portfolio side, but also on engaging in the various types of insurances to protect your financial assets. Estate and legacy planning, and education funding for children or grandchildren, oftentimes when you're saving for that goal, along with competing goals such as retirement. And then last but not least, charitable giving and legacy planning, how that can tie into a comprehensive plan. So I feel this is a very timely webinar because there's lots of headlines hitting the news. There's lots of changes with the new administration and some economic stresses and concerns and worries out there, as there always are. But oftentimes we talk to clients about controlling the controllables. The financial markets, the economy, these are things that are out of our control. What we can control oftentimes are on the side of the financial plan, the planning elements. Should we be looking at accelerated retirement contributions? Should we be considering a Roth conversion in the retirement accounts? Tax loss harvesting. So lots of these elements present opportunity to make lemonade out of lemons, so to speak. When we have some really what could be otherwise frightening times in the market, we can rely on our comprehensive financial plan to give us some peace of mind and actionable items. So let's get right into it.
Thanks, Dan. Well said. I think when I look at defining goals, I really like the moniker for SMART goals. And I borrowed this, I think, from different business courses and things like that. But we can use it and tweak it a little bit for financial planning. But SMART goals are specific, measurable, attainable, relevant, and time-bound. As Dan noted, one of the most popular goals that we hear about are retirement. And oftentimes we're talking about, a decent runway to retirement. So if someone has a goal that they'd like to be financially free and able to retire and live off of their assets by, say, age 60. Now we have a specific goal. We know the age they are today, and we know how long that is till age 60. With investments, often that T part is most important. And so understanding the time-bound nature of how much time we have will impact a lot of the decisions around what our investments are. It's relevant to you as your retirement date will impact your lifestyle, and that's a goal that you have out there. How attainable it is will kind of depend on how the analytics look and how much time you have and how much resources you've saved. Measurable would be that we're going back and look at it on an annual basis, see if we've made progress, see if we've fallen back a bit. And of course, the specificity of it is that we have a date of age 60 and that we are looking to be financially secure and able to rely on our retirement assets. Digging in a little bit deeper into how we structure goals is how we'll prioritize these. I like to look at goals as needs and wants and wishes. Needs are everything that you need to have to live, basically, to have a roof over your head, water, food, really the essentials. And those living essentials can really be pretty basic on most fronts. As we get out into wants, we're talking about lifestyle expenses. So we go from the need of just having a shelter to a nice shelter, a 5-bedroom, 2-bath shelter, whatever it is, whatever we're thinking out there. But wants can go into other lifestyle aspects too. How much we're dining out, how much we're vacationing, what type of car we're driving, what type of clothes we're wearing. There's some flexibility on these living expenses. Once we decided where we'd like to live, our water, our mortgage, our rent, those things are pretty well fixed. Our wants and our lifestyle expenses, they can flex a little bit. And if we're tracking it month to month, maybe one month we found that we ate out quite a bit more, and hey, maybe we need to hit the grocery this month and spend some more time dining in. Generally, once those two buckets are full, and especially if we're looking at a longer term plan, we can get into wishes. And these are items that, hey, if we're comfortable with our lifestyle, we have what we need to have in the way of comfort, of necessity, and what we want to have in the way of comfort, we get into wishes. And this gets into what would be nice to have, right? Do we want a second home? Do we want a classic car? Do we want to leave a certain amount of legacy? Do we want to help our grandkids with college? Do we want to help a certain charity? So these wishes, I would say, once those first two buckets are full, or at least we have a action plan for those, then we can get into some longer term, maybe, I guess, pie in the sky type of wishes that we can also plan around. Goals that we hear about often are legacy, I just mentioned, but just the idea of financial security. And financial security, I would say, is of course a wish for many of our clients, and it's something that we dig into and get more specific about as we retirement plan.
So how much risk is right for you? This definitely is the next step after goals, because a lot of people, you don't know what you don't know, essentially, and nobody wants the market to tank and their account values start dropping. So there's some thought exercises of what that would feel like and what's a comfort level, knowing that the markets go up, markets go down, and it's inevitable for both, essentially. The but a way to help guide that risk or give the confidence to enter the market where we are susceptible to these swings is going to be the goals that Jake was talking about. And that can help give us the time horizon. So if we have a known goal in the next 3 years that the house needs a new roof, pretty much fact, there's really no going around that. That's something that we would want to just keep in cash. It's not worth taking the chance of it going up or down. And so any of the a new vehicle purchase that we want to buy all in cash, just things like that, that can help give us the confidence for the other stuff that 5, especially 10 years out, especially when we're talking retirement. You retire at 65 and hopefully live to be 85. There's 20 years that we're going to live off of this, at least hopefully. And so that what gets us thinking it's longer term horizon. So what it's doing today, again, nobody wants it to go down, but that helps give us the mentality that, well, it's okay because I've earmarked these funds for later. And then the stuff that I know that I need to be spending money on in the next 1, 3, 5 years, it's in cash and not as susceptible. And that's also going to be what goals are we tying to each of these ideas, but also sub accounts. So traditional IRA may be invested a little differently than a Roth IRA, maybe invested a little differently than just a regular taxable brokerage account. And so to be able to do this, there's part emotions that we're trying to help manage and understand yours, but then also part of our insight into the markets with us doing this. The main difference is doing a retirement on your own is that's your one retirement, and it's 100% of what you'll know and go through. Whereas working here at like a firm, we deal with hundreds of retirements that we all have experience, sort of help. Everybody's different, but it helps gives that insight. So anyway, it's a big two-way conversation, and we have risk assessment tools that again get you thinking on these things so that we can just make sure that we're all on the same page with how we want to invest those accounts.
So as we dig more into a financial plan, we come to our personal balance sheet. And a metaphor I like to use is a financial plan is a little bit like taking a big road trip. So our goals are where we're going, and we got to start with where we're going to figure out how we can get there. Our risk is how fast we're driving. We going 65, we going 80, we going more than that. And our balance sheet's what we're in, right? How many people fit in this vehicle? What kind of miles per gallon we get, how much gas we're starting in the tank, how often we're stopping for food or restroom breaks or anything like that. But more specifically for a personal balance sheet, what we're looking at are your assets and your liabilities. And taking inventory of this tells us how far we can get as far as our road trip goes. So our liquid assets would be like cash, investments that you have, money that can be readily converted into cash, ultimately, is what a liquid asset is. Real estate would be the home you live in. Some people have rental properties. Business interests, we work with many business owners or prior business owners that have since sold their business and retired. And personal property. Personal property can sometimes be used and liquidated if there's a special collection that we have that we intend to liquidate. Sometimes that personal property can be used in our financial planning as well. Our liabilities are what we owe, so money that we know is going out the door, mortgages, credit cards. Again, if you're a business owner, you have some business loans out there, student loans, money we owe for our car, equipment rental, whatever that may be. But our assets are a positive side of our balance sheet, so they add to our net worth, and our liabilities tend to detract from our net worth. And it may not be that a liability detracting from the net worth is a bad thing, because in the right way, they can be a very useful tool to help build our net worth. So we know what vehicle we're in. Now we need to figure out how many miles we're going to drive per day, right? What our cash flow situation looks like. So when we think about what our income sources are while we're working, the vast majority of us, it's going to be salary and bonuses. Some of the people I work with, served in the military, and for that service, they may be able to have a current pension in addition to a salary. Some people have income from their business. Some people are pulling income from their investments. I mentioned rental property earlier. These are all different income sources that we have available to us. Nowadays, we're in this what we call the gig economy, right? So we may have a salary and bonus as our primary means of income, and some may have what is being called a side hustle, right? We go out and maybe after our 9 to 5, we're going out and driving Uber or we're driving for DoorDash, whatever it may be. Woodworking and selling that on Etsy. There are many different ways that we can generate income, but our primary source, our main thing is gonna usually be salary from our work. Our expenses go right along with the goals I mentioned earlier. Our essential expenses being kind of what we need to have to live, and what your current mix is of what you need and want and where your comfort level is. You want to have some savings is on top of that while we're working, because I don't think most of us would say we don't want to work for the rest of our lives. So retirement is going to be a goal for the vast majority of us, even if it's further away for some of us than others. Structuring your expenses is really important, because that helps with the monitoring these goals and being able to track what the goals are and measuring them. Very common ways to structure a budget would be, 50% of what our needs to have, our essential expenses, 30% on our lifestyle or our want to haves, and then 20% in savings or debt consolidation. It's a very common way to structure this. Another way to do it would be 70% into what you need to have, 20% into your wants, and 10% into savings and debt consolidation. This is going to depend on the person, but ultimately a system here is what we're looking for, and a way to track it and to allocate resources at the beginning of each time period that we're looking for. Into retirement, this changes a little bit. We don't have a salary anymore. We've gone from saving money into a 401k to flipping a switch and pulling money out. And it's a financial decision. It's an emotional decision. There's a lot that goes into it. But ultimately, that's one of the biggest shifts as we get into retirement cash flow planning is we don't have the savings component, but we're pulling from our savings. And we want to make sure that there's enough there to last to the end of our plan, respectfully said, is when we're called home, right? The day we pass. So we want to make sure that our investment portfolio withdrawals are aligned with that timeline and are able to sustain us for the rest of our lives. This is in combination with Social Security benefits that we'd be expecting to receive. Pension payments, I mentioned earlier. Like I said, some of our military members may get them and have a second working life, but a lot of pensions don't start till you're 60, 62, 65. And then other income streams. I have many retirees that do DoorDash or will go out and find, I'll get a lot of jokes about being a Walmart greeter. Something that generates a little bit of income and also is a good way to pass the time. You're getting up every day, gives you something to get out there and do. As much as retirement is a financial decision, it's a psychological decision. You go from having friends at work and every day having a lack of a better term, a purpose. You're getting up and going and doing things to now what, right? And understanding what your now what is important. As we get into retirement, the goals ultimately should stay very similar, and your cash flow should look a lot like it does before retirement. We want to continue doing the same things we're doing, maybe do a little bit more travel, maybe spend more time with our grandkids or our family members. Like I said, some of us maybe want to get that classic car and repair that, or want to get that family, second home on the beach or at the lake for the family. And our lifestyle and entertainment goals tend to increase. As I think about our budget and the day when I sit down with my wife and we're looking at our monthly budget, we tend to spend the most money on Saturday because it's our day. We get to go out, we have fun, whatever it may be. We generally are consuming and are spending a little bit more money. In retirement, every day is Saturday, right? So we need to account for that and probably plan for about 110% of what our pre-retirement expenses were. So an increase of 10% of what our expenses were before retirement is probably a safe way to look at that. In retirement, a lot of people also plan and say, I want to make sure I'm leaving something for my children or that I'm not a burden to my family members as I get near the end of life. And so that is a little bit of a difference as we look at retirement goal planning.
So on to portfolio management, kind of addressed to this a little bit briefly when I'm talking about risk, because as you can again look at that arrow, the ups and downs nature of it. And key components here are going to be tied to the risk, are going to be tied to the time horizon. And that's generally going to help guide the breakdown between stocks and bonds and then cash, which is, the more of one or the less of another, that's going to help be some risk reduction measures. And so just that general strategic level of allocation is the rule of thumb, all-weather retiree portfolio is 60% stocks and 40% bonds. And so I, view that as like, that's the strategic rule of thumb of our targets, what we're trying to generally be annually around that number. And the tactical element, though, is, well, that 60% stocks, well, which stocks? Because you've got large cap, small cap, international stocks. And from time to time, based off of our sentiment or our way of thinking, we may turn the dial a little bit, just a few degrees for, right now we have the tariff aspect. So we're not here changing the degrees, reacting daily to all these news articles, but as certain sentiments and trends start to develop, we may make maybe now is a time to maybe increase international a little bit as compared to US, or the vice versa. Maybe it's time to decrease international and increase US. Another way of, and a lot of people do think stocks when it comes to that, but even your bonds, it's good to have those diversified between short-term things like a CD, 1 or 2 years, but you can go out 5, 10, 20 years. And as we all know, these interest rates, these are susceptible to a person or people who make the decision on what to do with that. So it's kind of out of our hands. They're going to decide. And if right now, as interest rates are, there's not a lot of, it's not, the juice isn't worth the squeeze to go to these really long 10, 20, 30 year. So for right now, we just keep it short in those generally less than 5-year maturity type things. That's kind of a tactical move because strategically we should have the diversification over time. It just, as of right now, doesn't make sense. Eventually, though, it will make sense when things get, quote, back to normal, and we will do that. But again, that's kind of the difference. Strategic, big picture, tactical, little micro dial turns here and there. And the benefits are to diversify, to not put all your eggs in one basket, especially when most people that we're working with or come to us are working towards that. The goals that Jake was talking about are about retirement. And so the salary is going to go away, and maybe you have some of those pensions or Social Security that Jake mentioned, but you've also got this pot of money in 401ks or IRAs, however it may be. You're going to have to live off of that and create your own little pension and salary. And so we have to be careful about how we invest that, and what may have made sense the last 20 or 40 years, great, but now it's time you're in a different risk profile because you went from trying to accumulate and save to now not have inflation impact you as much, to protect yourself there, to not overspend, and to be able to bear on the market risks, because ultimately you don't lose unless you sell. And so even if it's down, that in a way is and can be a part of the plan itself. And the not selling strategy is that risk tolerance that has been communicated over and over with the time horizon and the goals, and then the investment policy with these diversification measures, meaning you're going to have some winners and you're going to have some losers. And that's the sea of change over time that'll develop of what wins and what loses. But collectively, we're just trying to raise the tide, which is to counter inflation when it comes to raising the tide. And then rebalancing is a tool to make sure that we're sticking with our policy so that it makes sense. There's rhyme to reason with the goals, which is rhyme to reason with the time horizon, which is rhyme to reason to all the way down to the individual holding, and why it's there within your portfolio. And here, Birchcreek, there's so many different mantras and ways of thinking about investment and philosophies. There's active, which is Coke and Pep, we're going to buy Coke, sell Pepsi, and we're thinking daily or even monthly time horizons where we're just trying to generate as much return as possible. Passive is we don't really care which company we're holding and things like that. We're picking almost like themes or just principles, such as back to that tactical allocation, as in, hey, our main focus is making sure that the 60% stocks to 40% bonds is the right allocation for you, because within that 60, we're getting indexes to accomplish this goal. So it is just the American sleeve of large companies, the American sleeve of small and medium size, the international sleeve. What is inside of those sleeves, we're more or less agnostic. We're voting on the performance of that certain sector or industry or field that the stocks are in. And by doing that, it also saves internal costs, which Dan will discuss a little bit with investment choices and whatnot. But by indexing, there's a lot of internal expenses that can add up. So we can also decrease that because most active people over time are not going to outperform that passive element. And it's also more tax efficient by going passive because you don't have people with these daily, monthly time horizons, which means they're buying and selling all the time, which can cause tax bills and whatnot, which would matter in like a taxable account, not so much in IRAs. But it's a passive, it really is a long-term buy and hold strategy, so long as you don't let things run out of control over time with things going up and things going down. That's how the rebalancing gets you back to that strategic level in line with the goals and time horizon that you have.
So to stay in that same vein with Sayer's discussion of the portfolio elements, we wanted to talk a little bit about advisory and investment costs and doing an analysis of your costs, because two matching portfolios, same breakdown of stocks, bonds, cash, same underlying holdings, one has a higher fee than the other, it's going to be a drag on performance. So there aren't many guarantees when it comes to talking about investments in your portfolio. Generally speaking, the more risk you take, the more reward potential. However, those two portfolios, if you're able to get in there and reduce fees, then you're essentially adding to the performance at the end of the day. Compounded over time, that reduction in fees can be very, very impactful with what you have remaining in the portfolio or what you have available to you to fund your retirement. So again, into the fees here, total cost of ownership of a portfolio, you may have advisory fees. If you're using any type of fund, whether it be an open-ended mutual fund or an exchange-traded fund, ETFs, you'll have internal expense ratios, as Sayer mentioned. You may have transaction costs if you're not in what we consider an advisory-based platform, meaning that you have variable expenses based on buying and selling. Or commissions related to the product type, such as mutual funds or annuities, or even individual stocks and bonds. You may have platform fees. Now, these would be separate from an advisory fee where you're paying for advice, financial planning and or investment management advice. These could be just where the account is held, charging you an annual fee or an annual rate on that. So to put some numbers behind it, just to make it a little more concrete, here's an example of $1 million portfolio in an advisory arrangement. So there's a fee rate. Generally, you'll see these billed as a portion of that amount quarterly, potentially even monthly. And in this example, you have a 1.25% advisory fee on the $1 million portfolio. They're using, in this hypothetical, a portfolio of mutual funds actively managed at the national average rate of internal expense, 0.59%. So on your $1 million portfolio, that's an extra $5,900 on top of your $12,500 advisory fee. And then they have the account on a platform that charges an overlay fee of 0.25%, an extra $2,500. So in this example, you have total costs coming in over 2%, of which, if you're checking your statement to figure out how much you're paying, you may be seeing the advisory fee and the platform fee, but you're probably not seeing the internal fund expenses. This is a non-transparent fee that really you need to do some digging in the fund literature to uncover. Another example, same $1 million portfolio, but it's not advisory, meaning that you do not have a fiduciary or an overlay advice per se on the account, but you're working with a broker, someone that buys and sells the securities on your behalf. You have a wide range of costs associated with that type of an account. If you have individual positions that you bought years and years ago and don't trade, you may have relatively low fees in a brokerage account. If you have lots of trading or some sort of high fee or upfront fee type of commissions on transactions, you could see as high as we've seen even 3% in transaction costs on an account like this. So just hypothetically, in this scenario, we're using the same mutual funds. You have these same internal expenses. You have upfront and transaction costs associated through commissions, and then you have the same platform fee. So one thing I want to point out is when you do have a brokerage relationship, you do have one of the most significant conflicts of interests that we find in our industry. And that is that your broker or advisor is incentivized to sell ABC position over XYZ position because it pays them or their firm more. So it's very product based, and you know, we know some folks that work on brokerage basis that are good people. It's not saying that they're all bad, but the structure in and of itself has conflicts of interest, so it's important to know that. So what we would encourage you to do is, take an account of what fees you're paying. If you are paying an advisor, aka you are delegating lots of these planning elements and some, if not all, of the investment management, is to ensure that you have a reasonable fee. So here's an example of $1 million portfolio. The advisory rate is 0.9%. The advisor gets in there, ensures that you're using either no or low cost type funds. So in this is an example of using index funds, the exchange traded funds, ETFs. The passive style of investing that Sayer mentioned cuts that fund expense, by 4/5. And then there are often the availability of platforms such as Fidelity, Schwab, Vanguard that do not charge platform fees per se. They might have one-time fees such as like if you close your account or send a wire transfer, need to order new checks, things like that. They might have small nominal fees, but there's no overlaying fee. It's also important that when you do have an advisory arrangement, meaning that you're paying an ongoing fee for an advice, that you're not also paying transaction costs, because that then brings in that conflict of interest. It eliminates the possibility of working with a fiduciary. A fiduciary advisor is one that is legally and ethically obligated to act in your best interest. And that can only happen if you're sitting on the same side of the table. So an asset under management fee or a flat rate fee would accomplish what we consider fee only, or an elimination of all those conflicts. Of course, just a quick mention for the DIY investors out there, you can eliminate and not delegate any of the advisory role and services and do this on your own. You still want to go in and make sure your fund fees are low. If you are paying transaction costs on trades, that those are low and reasonable, and how much has that been over the past 12 to 24 months to make sure that you're not doing it in a fee inefficient way. So let's jump in on some of the income topics now. It was Jake that was talking about fixed sources of income, mentioned pensions. One very, very important fixed source of income in retirement is Social Security. There's lots of questions around Social Security, and not just the solvency and what's going to happen out of Washington in terms of policy. But key decisions when you're coming up on retirement are oftentimes, when should I draw it? What happens if something happens to me? Will my spouse be taken care of? If you have dependents, will my dependents be taken care of? And then oftentimes tax questions. What if I take it while I'm still working? How much of it will just go right back to the government via income tax? So the earliest you can withdraw or draw on Social Security that you've paid into over the course of your career, the earliest you can draw is 62. The latest you can defer and take is age 70. And generally, folks retiring now have a full retirement age, full benefit, FRA, around age 67. And so you may ask yourself, well, why wouldn't I take it as early as possible? Why would I ever delay till age 70? Well, if you take it before that full retirement age, so example, age 62 instead of age 67, you have a drastically reduced benefit. So you are claiming it earlier. The only time that we're recommending to do that is if someone essentially has an imminent health concern, for example. They know that they're going to have a relatively short time on Social Security. They may come out ahead taking it early. However, that doesn't take into account if there's a spouse and there needs to be a survivor benefit either. So it is determining the appropriate age in concert with a spouse. Now, why would you wait until after full retirement age? There's an equivalent of an 8% increase every year you defer between your full retirement age and age 70. You never want to wait until later than 70, of course. That's the max you can get, and anything you don't draw on after that point, you're just wasting. But age 70 benefits, again, you get the increase in it, and it really can serve as longevity insurance for a lot of people because Social Security is there for your lifetime. And what we do is run a break-even analysis. So the question to ask yourself is, okay, if I say take at age 70 instead of age 67, I've now given up 3 years of that cash flow coming in. How long is it going to take me to make up those lost months of income? The break-evens we see are generally around age 81 or 82. Meaning, if you live later than age 81 or 82 in that analysis, you've come out ahead by deferring the benefit. Maybe you need to take it earlier than that because otherwise you're not going to be able to fund your lifestyle. Maybe you need to take it earlier than that for other reasons. But oftentimes folks that can swing it with their savings portfolio, we're having them defer until age 70. So there are a number of tools out there online to run maximizing strategies. We use a tool, Maximize My Social Security. You can find it online as well, or reach out. We're happy to run a complimentary analysis for you. We just need your Social Security statements that you can pull off of the government website. So it's one of those tricky issues with Social Security. If you tell us when you're going to die, we'll tell you exactly when to take the benefits. Of course, you can't do that. So we need to, run some numbers and use probabilities here and run a break-even analysis.
So a lot of the what we've talked about is, situation people at or near or into retirement, and that will certainly want to optimize your 401k for that. If you first set it 15 years ago, that may have had a risk tolerance that had a 15-year time horizon, and you may have never changed your elections or rebalanced within it, and things have run away, and maybe you've got more stocks as your strategic, overall allocation than is maybe it's more risks need to be taken if we're walking down towards retirement. But for those though that are on the other side of things, that we're not, we're more than 5 years out, and now we're trying to accumulate and build this 401k or retirement account so that you can retire off it into the future. You want to optimize the right savings rate. Rule of thumb is they say at least 10%, but up to 20. So let's say 15%. It's a good target to have. If you can consistently save 15% of your paycheck, get in that habit. That's the way to optimize is just your elections right off the get-go. And that also includes your employer match. So if they're going to give you 5%, you can count that towards your 15. So it doesn't have to 100% be coming from you. But then what you're invested in. And they have target date funds, of course, various mutual funds. These tend to not be as expensive in a 401k. That does tend to be a benefit rather than those other expenses that Dan was mentioning as individuals get charged. You have benefits of being pooling your assets there. But yeah, you want that 401k to be tailored and making sense with everything else that you're doing. And that's also in regards to historically, it was the pre-tax, the traditional routes, but now they have Roth options a lot of times. And so, the question is, do I do 100% pre-tax, all of it, a portion, 50-50, Roth or traditional? Those are all questions to help or that need to be answered because you want to be working towards a path that's intentional for one day living off of these type of assets. It also goes into those other employee benefits, not just these retirement accounts, but HSAs, if you happen to have one. We're not really at a stage where a lot of people have a huge substantial savings in the HSA that they're retiring with, but that'll happen one day. More and more people doing the higher deductible plans, and same principles apply with goals and risk tolerance and time horizon. and asset allocation, because HSAs can be invested. So that means they can go up, they can go down. So just again, want to make sure that makes sense for your eventuality of how you're going to use those funds, because there's definite tax benefits to the HSAs. Likewise, understanding the difference between an HSA, which will travel with you year by year, employee or employer by employer. FSA is an election that you do during HR benefits time, and that's what it is for the year. Unless you have a very specific reason to cancel it, most likely those are use or lose funds. So you just want to be sure that you know what you're signing up for a lot of times with these benefits. If you happen to be an executive, so these I'm talking kind of general employee level benefits, but if you executive compensation kind of is a new chapters of that being an employee book, and just kind of understanding your rights, what restricted stock units are. There's certain vesting requirements, which your 401k may have too when it comes to that match, knowing that, hey, if I want to get 100% of that match, I have to stay for X amount of years. That may be the case with RSUs and different stock options that your company incentivizes you to stay. They want to incentivize you financially, and part of that is your salary, but then some of these perks if you work for a publicly traded company. And so the trick is going to be, it might be a good deal, discount, you might have a good benefit there with getting the stock at 15% discount, let's say. But it's also worth analyzing the stock, the company itself. You work for them, you have certain insights, but it may not be worth, and it's maybe too much risk, and the math doesn't really line up. And so maybe it doesn't make sense, even if you have the option. Other people, maybe it is a great deal, but we don't want to get too concentrated though, because you really don't want to put all your eggs in one basket. And even if we like the stock going forward, we like the deal that they're giving you, we just want to be careful that it doesn't become your sole driver towards your retirement down the road.
Much of what Sarah's talking about ties into tax planning around retirement, right? So workplace retirement plans, pre-tax versus Roth, when to execute my stock options, lots of tax planning elements to these questions. Those tax planning elements can change, or sometimes the priority heighten when you're approaching retirement. Because again, for most people, the largest savings goal during their lifetime, they want to do it in a very tax efficient way. When we think about tax planning, oftentimes people think about reducing the amount of tax they have to pay in a given year. Let's face it, it's coming out of our wallet. It's painful at tax time if we owe, especially if we look back and say, shoot, I should have done this. I should have contributed to my HSA or my retirement account, or I shouldn't have sold at that gain, or it can kind of be painful in any one point in time. But really, I think the most efficient strategy when it comes to tax planning is to zoom out and think long term. There are steps that you could take in this calendar year that create a tax liability in 2025, but could save you a lot of money in the long run. And tax law is always changing, of course. In fact, it's hard to keep up with. But with some planning ahead of time, you can take care of things like, should I be doing traditional or Roth this year, of course. But at some point, those pre-tax dollars in retirement accounts have forced distributions, whether you need them or not, the dreaded required minimum distribution. So it's based on your life expectancy, and as of some relatively recent updates, starts at age 73. So RMDs, as they're known as, start at age 73, around 4% of your pre-tax retirement savings value, and then go up from there, because again, it's based on your life expectancy. A related strategy to that, a potential one that can help eliminate required minimum distributions in the future, or just a strategy to save taxes overall in retirement accounts, is using Roth, and specifically a Roth conversion. Roth conversion is grabbing pre-tax dollars and moving it over to Roth. You would pay, again, more tax in that given tax year to accomplish that strategy. But then the beauty of the Roth IRA or Roth 401k is that all of the growth on that money from then on is tax-free. So how it relates back to retirement, I'll give an example of clients that came to us. They had very, very healthy savings, and they also had healthy fixed sources of income through pensions. So they're looking out ahead, 10 years when they reached RMD age, and knew that they would have lots of forced, unwanted taxable income. So we put together a plan to do what is a relatively aggressive Roth conversion 7-year strategy that's forecasted to save them over $900,000 of federal tax during their lifetime. And retirement accounts now, as they pass to heirs, specifically, let's give the example of children. If they pass to children, now they need to be depleted within 10 years. The Roth has no required minimum distributions. It can literally be left invested for the next 10 years after inheritance, and adding to the timeline of that federal tax savings in that example. So some really, really potentially impactful strategies. I also mentioned at the beginning of the call the ability to kind of control the controllables when the markets are going haywire, maybe the markets are down big. There are oftentimes tax strategies that you can take advantage of, such as harvesting tax losses in your non-retirement portfolio, being very intentional about which part of the positions you're selling, what we call tax lot selection. So to actually give a flipped example of selling when things are down, there is a 0% capital gain rate bracket. So folks that fall into the 0% bracket, maybe they've retired and now they don't have that earned income, and they're living off of some taxable money that doesn't generate a lot of income that hits their tax return. They might be able to take taxable gains in their non-retirement account and not pay any capital gains on it. So there's a number of strategies. Again, we're not going to go into them all today, but very, very important element when you're considering your financial plan.
And insurance is a big part of your financial plan. I think when we think about our costs, this is one of those often fixed costs that can tend to be a little bit striking if we sit down and look at it. I think it's helpful to define what we view insurance to be, which is offloading risk in exchange for a premium. You are paying them to assume risk for a future loss of something. When we think about the big aspects in some of the larger insurances out there that are available, personal insurance comes front of mind. Your home and auto insurance, these guys have the best commercials on TV, and often you can find savings by comparing insurance coverage. And if you leave it for a period of time, these premiums can sometimes creep up on you, and you maybe have more coverage than you need, or you may just be paying a premium that isn't fair when compared to market rates. So understanding what you're paying for home insurance, auto insurance, and potentially some liability coverage, some umbrella liability coverage that you can get through your homeowners or rental insurance would be important. Life insurance is another big aspect of what we do, in that we're insuring the risk of our loss of income. For the vast majority of people that we work with, that's what we're looking at. And in most cases, we're looking at the time that we're receiving an income. So how much time do we have till our retirement? What our income is, what our liabilities are that are out there that we'd want to cover. This is a bit of a different number for everybody, but usually what we find is most effective is what's called level term insurance, that covers for your working career and covers, like I said, everybody's value is different. But if you're looking to replace your full income, you're talking quite a high dollar value. If you're looking to replace your mortgage, that number's pretty fixed. Disability coverage is another important insurance that we're looking for our working lives. This is the risk that you are not able to perform your work function as readily available. I was talking with a gentleman the other day that is a podiatrist, and if he were to strain his hand, he can't do surgery on the foot, and that calls for a need for disability insurance. Understanding how you're paying for that, if you're paying for it, and if your employer's paying for it, how it would pay out. Is it pre-tax? Is it post-tax? The amount they're covering, is it 65%? Is it short? Is it long-term? All of these are going to be important in understanding their impact on should something happen to you will be incremental in your financial plan. You're much more likely to be disabled than you are to die. So this is often overlooked, but a critical part of a financial plan. As we get into retirement and be late in our years of retirement, long-term care becomes a big discussion. This is huge right now because we have a large generation moving through the healthcare system, and we're seeing the strain. We can offload some of that with long-term care insurance. Nowadays, this is kind of going by the wayside because traditional insurance for long-term care has become too prohibitively expensive, but there are other options out there that you can pay into a policy and still receive a death benefit if some of that is unused. So considering what long-term care may cost down the road, may call for a long-term care needs analysis as well.
And I'm going to speak about some estate planning essentials. And this is actually, this is still considered in risk management because it's an eventuality that we're going to pass away. Financial planning is planning for that inevitability. That is guiding the time horizon. And when take Social Security, we obviously don't know when, but we know it will happen. And so there are certain very basic things that you can do ahead of time that really help things later on down the road, financially and emotionally, because if things have to get probated after you pass away and you don't have the plan set in place, which you do have a plan, the state has one, there's a default. It is, it's not a crazy plan. It's kind of commonsensical, but typically it requires hiring an attorney to process all of this through the court, which means that there is a court involved. There's public filings that people could find out whatever your estate was. You got a judge involved, and that attorney takes a pretty hefty fee to do all of this on an extended timeline that your loved one is going to have to manage because they're delegating this, but still responsible. We like to recommend, there's lots of different estate planners in the area. They're, kind of personal, and different shops are good at different things, and just trying to create that right match for a person so that we just know it gets done properly. And then most importantly, instead of having that nice and pretty binder with all the different tabs, a lot of times when you get an estate plan completed, there's a homework assignment. You've got to get all your accounts titled and labeled properly so that they all feed into this bucket at the end of the day. And so that's real important from our, just from a planning perspective, is do you have one? Or maybe you did and it's 10, 15, it was again at a different time period when that was applicable with different laws and situations with children or grandchildren and whatnot. So just seeing if there is one, maybe it needs to be updated, and then making sure all of the designations are lined up and coded properly so that we're just trying to eliminate hiccups and hurdles, especially for an eventuality with something like this.
Education planning is often a goal of our clients, whether it be helping immediate children, grandchildren, and just like any of our other goals, we're looking at our funding timeline, right? How soon is this person going to be going to school? How much do we want to cover? Do we want to cover in-state? Do we want to cover private? And keeping in mind that college education seems to inflate much more than regular basket of goods, right? I think back 20, 30 years ago, how much more affordable college was than it is now, and have to assume that will kind of continue that trajectory. It would be great if it slowed down, but our general assumption is that college inflates more quickly than our regular basket of goods. There are many tax-effective ways that we can save for college that will allow our gains to be tax deferred, or if used for the appropriate costs, which would be qualified education costs, room, board, tuition, they'll grow tax-free, and they'll pay to that university directly at that point in time when that student is in college. 529s are the most popular. These are usually state-sponsored. Some of the lesser used options are Coverdell ESAs, and then we get into some of the UTMA and UGMA accounts. These can be used for college expenses, but ultimately at the point of when that person who that account is established for reaches the age of majority, which is usually 18 or 21, dependent on the state we're in, it's their money. So they can use it for college or whatever they'd like. And so that is kind of dependent on the person, but at 18 years old, we may not be making our best financial decisions. And so that money may not necessarily find its way to a university. Just keeping that in mind.
And to wrap up here, oftentimes clients we engage with are, helping out with causes that they care about. So they often do that with their time and talents, but also their treasure. So, there are certainly ways to give on a tax advantage standpoint. It behooves you to be familiar with these. We often say don't let the tail wag the dog, so to speak. Don't start giving hundreds of thousands of dollars because there's a tax benefit to it. Give because you care about the causes. And then if you've been giving cash or in lieu of giving cash, talk to an advisor about tax advantage ways to do that. For example, you could be giving appreciated stock out of non-retirement accounts. Even if you decide you want to continue holding that position and it's not, in effect to reduce the position, you could buy it back at market value and almost do a reset on your tax basis. And another example is when you hit that dreaded RMD age that I referenced earlier, age 70, actually age 70 and a half and beyond, because they didn't update the age, you could give part of your pre-tax IRA directly to charity and never have that money hit your tax return. So just a couple of examples of ways to leverage your dollars, be tax efficient, and supporting the causes that you care about, an important part of your plan. So I'll recap here and go over what we went over, and hopefully, again, you've had a chance to feel like you've gotten your arms around at least what topics to consider when formulating your financial plan or when working with an advisor to formulate a comprehensive financial plan. Again, that foundational planning of goals, risk tolerance, personal balance sheet, where are you today, cash flow, how much is it costing, the retirement planning and how that specialized cash flow comes into play, investment strategy, tax optimization, risk management, both on the portfolio and insurance side, leaving a legacy and planning for your estate for those that you're leaving behind, entitling accounts appropriately, funding education for kids and grandkids or others, and giving to causes that you care about. We do have 1 extra minute here, and we had a question come in to the Q&A side. In the meantime, I'll go ahead and put up our contact information. If anyone has questions after the webinar, feel free to reach out to us. We'll also be sending the slides and recording to you as well. So the question was related to how to learn more about individual companies inside of a portfolio. And I'm going to use the example of when you're using funds, which are baskets of investments. And specifically, the question was related to drilling down on environmental or social elements of the various businesses, because obviously when you're buying stock, you're becoming an owner of a business, so you want to believe in that business and how they do what they do. So the recommendation then would be to, first off, if you're looking for funds or the baskets of investments that do some of that filtering out and follow certain themes or criteria, look for ESG fund providers. That stands for environmental, social, and governance fund providers. every mutual fund or ETF, which are those index or passive approach, has what's called a fact sheet, or you could even go in the thicker prospectus. This is fund information. It's published periodically, and they go as far as to list every holding in that fund. So if you're building out, for example, an individual stock portfolio, but you want to use this type of criteria, you can go into a fund's literature and see the types of companies that they're investing in that follow these certain parameters. And then there are indexes or scoring out there related to ESG funds and the underlying companies. So yeah, a lot of information out there on those. I don't see any other questions, Q&A as of right now. Anything we missed, guys? Sayer, Jake?
I think we got most of it, but any additional questions, reach out to Kendra and we'll be happy to address them.
Yes, thank you everyone for attending. We hope you have a wonderful rest of your day.
Thanks, everyone.